My name is Daniel Carter, and today I want to tell you about a mistake that has quietly turned thousands of honest Americans into the subjects of federal investigations. Not because they committed fraud, not because they were hiding money, but because they handled their own savings in a way that looked suspicious to a computer. A few years ago, I spoke with a recently retired elementary school teacher from Columbus, Ohio. She had spent more than 30 years doing everything financial experts tell people to do. She lived within her means, avoided debt, and built a retirement fund one paycheck at a time. By retirement, she had accumulated nearly $94,000 in savings along with a $23,000 certificate of deposit that had just matured. She needed a new roof for her home, and the contractor she trusted quoted the project at $9,800. Nothing about the situation was unusual. She went to her bank, accessed her own money, and moved it into the account she normally used to pay bills. To her, it was nothing more than transferring personal savings to cover a home repair. 3 weeks later, everything changed. Her bank account was suddenly frozen. A letter arrived explaining that her transactions were being reviewed as possible suspicious financial activity under federal law. She had never heard the phrase structuring. She had never imagined that depositing her own money could trigger a federal investigation. Yet over the next 6 months, she lost access to much of her savings, spent more than $11,000 on attorneys, and watched her financial life unravel, all without ever being accused of stealing a dollar. Eventually, the investigation ended. No criminal charges, no conviction, no wrongdoing. But the legal bills remained, and no one reimbursed her for them. The money she spent proving her innocence was simply gone. If you understand one rule before this video ends, you may never have to experience what she did, because her story isn't unusual. Every day, retirees, veterans, widows, and small business owners find themselves caught inside a financial reporting system they never knew existed. According to the Financial Crimes Enforcement Network, banks file millions of suspicious activity reports every year. Many involve ordinary customers whose transactions simply matched patterns that banking software was programmed to notice. Most people assume a bank employee personally decides whether something looks suspicious. That isn't how today's banking system works. Software watches first. People review later. If the software detects a pattern that resembles money laundering, tax evasion, or structured deposits, a report can be generated before anyone understands the real story behind the transaction. And once that process begins, your bank is often prohibited from warning you. That's the part many Americans never hear about. Today's financial system wasn't designed to explain itself. It was designed to detect risk. Banks operate under federal regulations that require them to monitor accounts, identify unusual cash activity, and report transactions that meet specific criteria. They aren't doing this because they distrust their customers. They're doing it because federal law requires them to. Understanding those rules may be one of the most valuable forms of financial protection you can have. So let's begin with the first one. Most Americans have heard about the so-called $10,000 rule. What many people believe is simple. As long as I stay below $10,000, nothing gets reported. That belief is wrong. Federal law requires banks to file a currency transaction report whenever someone deposits or withdraws $10,000 or more in cash. This requirement comes from the Bank Secrecy Act, legislation originally passed in 1970 to help investigators combat organized crime and money laundering. The report itself is automatic. Your teller doesn't choose whether to file it. The branch manager doesn't vote on it. Once a qualifying cash transaction occurs, the reporting system takes over. But here's where many honest people get into trouble. Years after the law was passed, Congress realized that criminals would likely avoid the reporting threshold by making smaller deposits instead. Instead of depositing $20,000 once, Someone might deposit $9,500 today, another $9,700 tomorrow, and another amount a few days later. To address that problem, lawmakers created what is commonly known as the anti-structuring law. This law doesn't focus only on the amount, it focuses on intent. If someone intentionally breaks transactions into smaller pieces to avoid reporting requirements, that behavior can become a federal offense. The challenge is that computers cannot read intent. They only recognize patterns. And that's exactly where ordinary Americans sometimes become collateral damage. Imagine you've sold a vehicle. A few weeks later, you receive a Social Security back payment. Then, you move money from a matured certificate of deposit. Individually, every transaction is perfectly legitimate. Together, however, automated monitoring systems may see multiple cash movements occurring within a relatively short period. The software doesn't know you're replacing a roof. It doesn't know your husband recently passed away. It doesn't know you sold a pickup truck. It only sees numbers. That's why understanding how the system thinks is so important. Because once a suspicious activity report is submitted, the bank is generally prohibited from telling you it happened. You won't receive a warning. You won't receive an email. You won't be asked to explain your intentions before the report is filed. The information is simply transmitted through the reporting system, where federal agencies can review it as part of broader financial monitoring programs. Most people never realize how much of modern banking operates behind the scenes. And by the time they discover it, they're already trying to explain transactions that made perfect sense to them, but looked very different to a computer. Now that you understand how the reporting system works, let's talk about something even more important. The software monitoring your account isn't trying to determine whether you're an honest person. It's trying to identify patterns, and patterns alone are often enough to trigger additional scrutiny. That surprises many people because they assume intent comes first. In reality, the pattern is usually what gets the process started. Intent is something investigators may try to determine later. Think about how retirement often changes a person's financial life. For decades, your banking activity follows a predictable routine. A paycheck arrives every 2 weeks. Utility bills are paid. Grocery purchases appear. Everything looks consistent. Then retirement arrives. Suddenly you begin closing investment accounts. A certificate of deposit matures. You sell a second vehicle you no longer need. Perhaps you receive a retroactive Social Security payment. Maybe you inherit money from a family member. Or you're helping settle the estate of a spouse who recently passed away. None of those events are unusual. In fact, they're common parts of retirement. The problem is that automated monitoring systems don't recognize life events. They recognize transaction behavior. A computer can't tell whether you're reorganizing your retirement savings or attempting to disguise illegal activity. It simply compares today's activity with everything that happened in your account over the past several months. If enough variables change at once, your account may receive additional attention. That's why so many retirees are surprised when a perfectly legitimate transaction suddenly creates unexpected questions. The truth is, banks are under enormous pressure to identify suspicious activity. Federal regulations require them to report transactions that appear unusual. Failing to report genuinely suspicious behavior can expose financial institutions to severe penalties. As a result, banks often choose caution over certainty. From their perspective, filing a report is safer than failing to file one. That doesn't mean you've done anything wrong. It simply means your activity deserves another look under the system's rules. Here's another misconception I hear all the time. People believe that staying below $10,000 somehow keeps them invisible. It doesn't. Many financial institutions begin reviewing activity well below that amount. Multiple cash transactions, repeated deposits over several weeks, or several unrelated cash movements can all contribute to an automated alert. Again, that doesn't automatically mean anyone believes you've committed a crime. It simply means the software wants someone to review what happened. Unfortunately, by the time that review begins, you're usually unaware that anything has been reported. That's because suspicious activity reports are confidential. Federal law generally prohibits banks from telling customers whether one has been filed. Imagine receiving no warning whatsoever. You continue using your account normally. Weeks later, a hold appears. Your debit card stops working. Automatic bill payments begin failing. You call your bank expecting a simple explanation. Instead, you're told only that your account is under review. Most people panic at that moment, and panic often leads to mistakes. This is why preparation matters far more than reaction. The best way to protect yourself is to create a transaction history that tells a clear, logical story. For example, suppose you recently sold your truck for cash. Instead of making several deposits over multiple days, deposit the full amount at one time. Bring documentation if possible, a bill of sale, a copy of the title transfer, anything that clearly explains where the money originated. Documentation doesn't eliminate reporting requirements, but it helps establish a legitimate explanation before unnecessary questions develop. The same principle applies if you're moving money after a certificate of deposit matures. If your bank already holds both accounts, ask whether the funds can be transferred electronically instead of withdrawing cash first. Electronic transfers leave a detailed audit trail showing exactly where the money came from and exactly where it went. That kind of documentation speaks for itself. Cash doesn't. Cash is anonymous. And anonymous transactions naturally receive greater scrutiny under anti-money laundering regulations. Another mistake retirees sometimes make involves moving money several times in a short period. Savings to checking, checking to another bank, then back again after deciding on a different investment. To you, those transfers make perfect sense. To automated software, repeated movement between accounts can resemble one stage of money laundering known as layering. Of course, you're not laundering money, but the software doesn't understand your intentions. It only measures activity. The fewer unnecessary transfers you make, the easier it becomes for your banking history to tell a simple, consistent story. There's another habit I strongly recommend. Keep records. Not because you've done anything wrong, because memory fades. If you ever need to explain where funds came from 6 months later, you'll be glad you wrote it down. Maintain a simple notebook or digital file listing major transactions. Record the date, the amount, where the money came from, why it was moved. Attach receipts whenever possible. Selling a vehicle, save the bill of sale. Receiving an insurance payment, keep the settlement letter. Closing a CD, keep the maturity notice. These documents can answer questions long before anyone asks them. People often assume this level of organization is excessive. It isn't. It's one of the easiest ways to protect yourself from misunderstandings. Remember, investigators aren't reading your mind. They're reviewing documents. The better your documentation, the easier it becomes to demonstrate that every transaction had a legitimate purpose. By now, you may be wondering whether this happens often. Unfortunately, it does. Retirees are especially vulnerable because retirement naturally creates financial activity that differs from working life. Large withdrawals, estate settlements, insurance proceeds, home sales, investment changes, all of these are perfectly normal. But together, they can produce transaction patterns that appear unusual compared with years of routine banking. That's why understanding the system before something happens is so valuable. Because once an investigation begins, proving your innocence often becomes much more difficult than preventing unnecessary questions in the first place. Now let's move from understanding the problem to preventing it. Everything we've discussed so far comes down to one simple principle. Make your transactions easy to understand. The easier your financial activity is to explain, the less likely it is to create unnecessary questions. The first rule is surprisingly simple. Whenever you're depositing a significant amount of cash, avoid breaking it into multiple smaller deposits. Many people believe they're helping themselves by staying below a certain dollar amount. In reality, repeatedly depositing smaller amounts within a short period often creates more attention than depositing the entire amount at once. If you have $18,000 from the sale of a vehicle, don't deposit $9,000 today and another $9,000 next week. Deposit the entire amount. Let the required reporting occur if necessary. There's nothing illegal about depositing your own money. The reporting requirement exists whether you like it or not, and trying to avoid it, even unintentionally, can create complications that are completely unnecessary. The second rule is one that almost nobody talks about. Tell your bank where the money came from before anyone has to ask. This doesn't require a lengthy explanation. It can be as simple as saying, "I'm depositing the proceeds from selling my pickup truck," or "This came from a certificate of deposit that matured yesterday," or "These funds came from an insurance settlement." When documentation exists, bring it with you. A bill of sale, a closing statement, a CD maturity notice, insurance paperwork, anything that establishes a clear paper trail. Think of documentation as insurance. You hope you'll never need it, but if questions ever arise, you'll be grateful it's available. The third recommendation involves how you move money between financial institutions. Whenever possible, avoid using large amounts of physical cash. Electronic transfers, bank wires, and cashier's checks all create detailed records showing exactly where the funds originated. Cash leaves far fewer clues. From an investigative standpoint, that's why cash receives much greater scrutiny. If you're transferring money between two accounts that belong to you, ask your bank which method creates the strongest documented trail. In many cases, an electronic transfer accomplishes the same goal while reducing unnecessary attention. Another habit worth developing is reviewing your own account activity every month, not just to watch for fraud, but to make sure everything makes sense. Look for unusual holds, unexpected restrictions, transactions you don't recognize. Most account issues become much easier to resolve when they're identified quickly. Waiting several months often makes the process far more complicated. Now let's discuss what happens if your account is actually restricted. This is the moment where many people panic. Please don't. A restriction doesn't automatically mean you've done anything wrong. It also doesn't mean you've been accused of a crime. Sometimes banks simply need additional documentation before allowing certain transactions to continue. The important thing is responding calmly and methodically. Start by contacting your bank's fraud or compliance department, not general customer service. Ask for a written explanation describing why the restriction exists and what documentation may be required to resolve it. Keep detailed notes. Write down every conversation. Record names, dates, times, and reference numbers. Good documentation isn't only important for banks, it's important for you as well. If you're asked to visit a branch, bring every document related to the transaction. If the money came from selling property, bring the sales paperwork. If it came from an inheritance, bring the estate documents. If it came from an investment account, bring the statements showing where the funds originated. The more complete your documentation, the easier it becomes to demonstrate that your activity was entirely legitimate. If you believe your bank handled the situation improperly, you also have options. The Consumer Financial Protection Bureau accepts complaints from consumers who believe financial institutions failed to follow appropriate procedures. Filing a complaint doesn't guarantee a particular outcome, but it creates an official record and often encourages faster communication between customers and financial institutions. Many people don't realize this resource exists. It's worth remembering. Now I'd like to answer a question I hear frequently. Why doesn't the government simply explain these rules to everyone? It's a fair question. The answer is complicated. The financial reporting system was designed primarily to identify criminal organizations, money laundering networks, tax fraud, and terrorism financing. Educating the general public has never been its primary purpose. Banks receive extensive compliance training. Federal investigators receive extensive compliance training. Ordinary Americans generally receive none. That's exactly why misunderstandings occur. The average retiree has no reason to study federal banking regulations. Most people assume common sense is enough. Most of the time, it is. But sometimes, common sense collides with automated compliance systems that operate according to completely different rules. That's why I believe financial education matters, not because I expect you to memorize federal statutes, but because understanding a few basic principles can prevent enormous headaches later. One of those principles is recognizing who faces the greatest risk: retirees moving retirement savings, recently widowed spouses settling estates, families selling inherited property, people receiving insurance settlements, small business owners who regularly handle cash, farmers, landlords, anyone experiencing major financial transitions. These aren't suspicious people. They're simply experiencing life events that naturally create unusual banking activity. Unfortunately, unusual doesn't always look ordinary to compliance software. If you recognize yourself in any of those situations, slow down before moving money. Plan the transaction, gather your paperwork, choose the simplest path possible. Those extra few minutes of preparation can save months of frustration later, because once questions begin, answering them often takes far longer than preventing them in the first place. Before we finish, I want to leave you with one final thought. Most people believe financial disasters happen because someone made a reckless decision. In reality, many of the most expensive mistakes happen to people who are doing everything right. They're paying their bills, they're saving for retirement, they're following the law. The problem is that today's financial system doesn't judge character, it evaluates data. Computers don't know whether you've spent 40 years teaching children, serving in the military, or running a small family business. They don't know you've just buried a spouse or sold the family home after decades of ownership. They don't know you're simply moving money from one account to another because your roof needs replacing. They only recognize patterns. And sometimes those patterns resemble activity the system was built to detect. That's why education matters so much. The goal isn't to become an expert in banking law. The goal is simply to understand enough to avoid creating unnecessary problems for yourself. If you remember nothing else from today's video, remember these 8 principles. First, don't split large cash deposits into smaller transactions. If the money is legitimate, deposit the full amount. Second, whenever possible, explain the source of significant funds before someone has to ask. Bring documentation with you. Third, use electronic transfers, cashier's checks, or wire transfers instead of carrying large amounts of cash whenever practical. They create a much clearer record of where the money came from. Fourth, avoid moving the same funds repeatedly between multiple accounts over a short period of time. Simple transactions are easier to understand than complicated ones. Fifth, keep records of major financial events. Save receipts, save contracts, save closing statements. Those documents may become your strongest protection months later. Sixth, review your bank statements every month, not only for fraud, but also for unexpected holds, restrictions, or unusual account activity. Seventh, if your account is ever restricted, stay calm. Contact your bank's compliance department, gather your paperwork, and respond with facts, not emotion. And finally, never assume that because you've done nothing wrong, you'll never have to explain yourself. Preparation is always easier than correction. I often hear people say, "If I'm innocent, I have nothing to worry about." I understand why they believe that. Most of us were raised to think honesty alone protects us. Honesty is essential, but documentation is just as important. The financial system relies on records, not assumptions, not memories, records. That simple habit of keeping paperwork organized can save enormous amounts of time, money, and stress. Remember the retired teacher we talked about at the beginning of this video? She wasn't investigated because she committed fraud. She wasn't investigated because she stole money. She was investigated because a perfectly legitimate series of transactions resembled a pattern that banking software had been programmed to identify. Eventually, everything was resolved. No criminal charges were ever filed. Her money was returned. Her account was restored. But the legal fees, months of uncertainty and emotional strain, could never be recovered. One conversation with her attorney changed everything. He told her that if she had deposited the funds in one transaction, clearly documented where the money came from, and created a straightforward paper trail, the investigation most likely never would have happened. That advice came too late for her. Hopefully, it isn't too late for you. My goal isn't to make you afraid of your bank. Banks perform an essential role in protecting the financial system. Most bank employees are simply following the federal regulations they're required to follow. The goal is understanding how those regulations affect ordinary people. When you understand the rules, you make better decisions. When you make better decisions, you dramatically reduce the chances of becoming caught in a situation that never should have happened in the first place. Knowledge doesn't eliminate every risk, but it does eliminate many preventable mistakes. That's why I created this channel, not to create fear, but to replace uncertainty with understanding. If today's explanation helped you see the banking system from a different perspective, I encourage you to subscribe. Every week, I break down complicated financial rules into practical information that retirees, veterans, and everyday Americans can actually use. And if you know someone who recently retired, sold a home, inherited money, or is managing a loved one's estate, consider sharing this video with them. One conversation today could prevent months of unnecessary stress tomorrow. In my next report, we're going to examine one of the fastest growing financial scams targeting older Americans. How criminals are using legitimate Medicare information and trusted medical providers to steal benefits without victims realizing it until months later. It's happening across the country, and understanding how it works may help you recognize the warning signs before you're affected. Thank you for spending this time with me. I'm Daniel Carter. Take care of yourself, stay informed, and I'll see you in the next report. Disclaimer: this video is provided for educational and informational purposes only. It should not be considered legal, financial, or tax advice. Federal banking regulations can change, and every financial situation is unique. If you have questions about your specific circumstances, consult your financial institution, a qualified attorney, or the appropriate government agency before making financial decisions.